Hey, did you hear the 30-year fixed mortgage rates dropped overnight big time down to 5.99%? This is the first major drop that we've seen so far in 2026, and more are expected. This time a year ago, mortgage rates were well over 7%. By the way, if you don't know who I am, I'm Heather Myers, a longtime journalist in San Diego County. I'm a real estate agent, and I'm here to help you understand everything there is to know in real estate. My specific focus is on San Diego County, but today, stories like this, well, this reaches everybody across the country. Thanks for tuning in. Okay, a lot of you might be asking, why did this happen? Why did we see this major overnight drop in 30-year fixed rates? Well, yesterday, and it was late into the afternoon yesterday, the president put out a post on Truth Social. He's asking his representatives to purchase $200 billion in mortgage bonds. He's specifically talking about Fannie Mae and Freddie Mac. Those are the government-owned mortgage giants. He says that those two agencies have about $200 billion in cash. And as that happens, as we've seen historically, that should drop the 30-year fixed rates. We saw it happen overnight just on speculation that this could go into place. So generally, a purchase like this would help the rates drop down. Again, we saw them drop 22 basis points overnight just on speculation that this giant mortgage bond purchase would actually be approved and go into place. The last time that we saw something similar to this, and I say similar because there's some fine print here, it was during the pandemic. That's when the central bank purchased mortgage bonds. And when we saw them purchase the mortgage bonds during the pandemic, boy, those rates dropped down. That's when people were locking in the 2 and the 3% range. Okay, a couple of lenders that I spoke with, they say we're not going to see rates drop that low, but we could see rates, according to them, drop into the low 5s, maybe even the 30-year fixed rate drop into the upper 4s. A couple more dominoes would have to fall into place for that to happen, but that is something that they do think could be a very real possibility, again, if this gets approved, if the president's plan to purchase these mortgage bonds does get approved. Now, this isn't the only plan that the president talked about this week. He is focused on trying to get the housing market under control again. So another proposal that he put forward, I believe it was Wednesday of this week, was for corporations, those massive investors, to be banned from purchasing single-family homes across the country. That was a complaint that he's heard, that we've heard even from you, is that people are tired of corporations buying up the single-family homes, increasing the home prices. And then a lot of families, a lot of couples, a lot of Americans feel like they're not able to jump into the housing market because they feel like corporations are purchasing all the single family homes that become available. There's some argument on both sides of that, but the president says he just wants to ban it altogether. That would give American families, American prospective homeowners an opportunity to purchase up these single family homes. So that was another proposal that he put out earlier this week. So I talked to my friend Minh Nguyen. He is a loan officer here in Southern California, has a hugely popular Instagram page. It is called What's a Mortgage. If you're not following him there, I highly suggest that you do because he has a lot of great nuggets on what's going on in the mortgage part of the real estate puzzle. So here's a bit of our conversation. Again, we had this conversation before the rates dropped down to 5.99%. So I wanted to share some of that conversation with you.
This is Fannie Mae and Freddie Mac. He's asked FHFA to lead it up to get Fannie Mae and Freddie Mac to buy mortgage bonds. Mortgage bonds, as you know, is debt. And the 30-year fixed mortgage is tied to mortgage bond. And that's what everyone is fixated on. So the 30-year fixed mortgage is tied to a mortgage agency bond. And these agency bonds are bundled up and purchased by investors. So if you were an investor and you had to buy a debt, if it was not a popular debt, you would want a high yield return because it's risky. But a big player comes in the game, like the government, Fannie Mae, Freddie Mac, and now there is a high demand for that bond. So if there's a high demand for that debt now, what happens to the yield? It drops. If there's low demand, the yield is high. So the yield drops, that correlates with mortgage rates. So now investors can sell mortgage rates at a lower rate because there's a higher demand for it. So if this actually happens, and there's speculations like does Fannie Mae and Freddie Mac have 200 billion to buy? If they do actually buy it, then similar repeat to 2020 to 2022. March 2020 to March 2022, the feds bought mortgage bonds. So when they buy these bonds, rates got better. So if it happens again, similar situation is going to happen. I don't think as crazy as it was in 2020 to 2022, but probably similar. But there's more than just that. So right now, as you know, mortgage rates are up. Mortgage rates have been improving slowly, but it's not where everyone wants it to be. I think there's greed involved because we saw rates in 2 to 3%, and people are expecting that again. So even though mortgage rates improve, people aren't going to be happy unless they see 2 and 3s, which is not going to happen. Our economy would probably fall apart if that does happen again. We'd have bigger problems. So as the feds or as a Fannie Mae and Freddie Mac buy mortgage bonds, if that does happen, mortgage rates will improve by default. If the feds cut interest rates while inflation stays low, which they're expecting to, these dominoes that keep falling, it will make mortgage rates lower and it should prop up the real estate market. I can't hear you.
Okay, this is why we go to you with stuff like this because you make it so easy for us to understand. But the big question is, when could this happen? And if it does in fact happen and everything goes as planned, what types of 30-year fixed rates could we potentially see?
I don't know. My prediction before this happened today, like it was unexpected. I was assuming rates were probably gonna drop. Right now, I think rates are about 6.25, 6 and 8, 6 and 3/8, maybe 6% to 5.875 if without this news on a conventional loan with the lender making money with the spread and all stuff, right? Not just some floor rate where people are charging insane points for. I'm just saying everything built in about 5.8756%, hopefully in summer. With this happening, I don't know, maybe a little bit lower. I don't think it's gonna get extremely low, but I'm hoping, fingers crossed, 5.5. And when I think it's gonna happen, the announcement was made today, right? Just like his other announcements, Trump's made in the past, it takes time for it to happen. If it does happen this year and it happens with the rate cuts, with low inflation, with high unemployment, then we're gonna see something pretty insane by the end of the year. I think right now everyone's going to hold off. The reason why is right now Jerome Powell's still in charge, and he, of course, is going to be replaced in May. So I don't think he's going to do anything to spook the market to cause inflation to go up. So I think it's all great news, but I think if it's going to happen, it's going to be subtle, unless we wake up next couple of days and Fannie Mae and Freddie Mac, which I think through FHFA Trump has a little more control of. He doesn't have control over the feds. If he can push that envelope to happen sooner, then we're going to see it happen sooner. So keep your eyes on when Fannie and Freddie starts buying bonds. They typically will announce it. You can see it on their website. That's when you know rates should improve.
Best case scenario and worst case scenario when you hear news like this. I mean, you're in the lending world, you know what this could do. People get their hopes up. They think they're going to see rates at 2 and 3% again when they hear news because most of us are just flat out uneducated when it comes to stuff like this. So let's talk about best case scenario and worst case scenario.
I think best case scenario, we see conventional loans 5.5, Govy loans 4.75. Best case scenario, worst case 6% for conventional and about 5.25 for government loans. Because I've already seen the envelope in September this last year, and then so in September there was like a couple days or a couple hours when the rates were low. Same thing happened in April. We saw what happened when the 10-year broke under 4%. Those numbers that I just said earlier were there. So worst case, that's going to happen again. So if the 10-year breaks under 4, I can see the rates I just told you.
One of the things that's been so interesting, I think we chatted about this last time, is we have been in like this stalemate for like months and years now when we're not seeing rates at 2 and 3%. They've been 6, 7, close to 8% at times. And there hasn't been a shakeup in the market, nothing to trigger rates and really in either direction. Maybe until today, maybe until that announcement, coupled with the announcement that the president made earlier this week that he may forbid corporations from buying up single family homes anymore. I know he had talked earlier, late last year, about a potential what was it, 50-year fixed loan?
Yeah, 50-year fixed loan and a assumable mortgage.
Yeah, things like that. Yeah, the assumable mortgage. It appears that the administration is trying to do something. Is it kind of like throwing spaghetti at the wall and seeing what actually sticks?
I can see the government really trying. Okay, it's like two people who want to get in a fight. Someone's gonna throw a punch. At least someone's punching. When you punch, you get lucky, you hit something. If you don't get lucky, you whiff. But at least you try. So I feel like the government is trying. So they're coming with different ideas. The 50-year mortgage, right, will lower payments for people who buy. Assumable mortgages for conventional. Right now, it's only for government loans. That means more people are going to have incentives to buy a home with a current lower interest rate. Porting your mortgage, you're able now to take your low interest rate wherever you go. So these factors right here with the Feds, no, with Fannie and Freddie Mac buying bonds just creates more demand. And now more people have their eyes open and they want to buy. The challenge is you have more eyes ready to buy, but still not enough inventory. So as they create demand, I'm hoping they come up with ways to cut the red tape locally so that builders can build. And now with all this demand, they can go out and buy. And if that happens, then I can see prices settling down.
If you have any questions about what this means for you, to see mortgage rates drop down into the 5.99% range, perhaps dropping even more as we get further along into 2026, don't hesitate to reach out. I have some step-by-step procedures I'm going to help prospective home buyers right here in San Diego County go through in order to make sure that you are ready to jump on the home of your dreams when it does become available. If you're selling, that's another component to this. What does this mean for home sellers here in San Diego County? I want to talk to you about that. I want to make sure that your home is positioned perfectly in order to attract the most buyers who are taking advantage of some of these lower rates. We're going to talk about everything from price, from strategy to marketing. My marketing plan it's unlike anything I've seen here in San Diego County as far as making sure that you have eyes on your home if you're putting it up for sale. So don't forget to hit like and subscribe to my channel. Reach out to me. Let's talk about your strategy here in 2026. Again, we are starting to see those mortgage rates tumble down to hopefully numbers that a lot of you can start taking advantage of, but you need to have the right team on your side to make that happen. So, hey, reach out. I'd love to help you.